What is up, everybody, and welcome back to the Fresh Finance Podcast. My name is Thomas Elms, and I have my co-host here, as always, Kyle Ryan. And today we are going to be talking about inflation. It's been a really hot topic in conversation as far as the economy, recession conversations, and it was really kind of the plight of last year. And we're starting to see some positive results in what just has been going on. And so Kyle and I today are just going to be talking about essentially, how we got here, but also how inflation affects the economy and you in particular. And also some things to just kind of watch out for going forward. So, Kyle, would love to just kind of hear your initial thoughts on the inflation conversation and what we're going to talk about today.
Yeah, I'm excited to talk about it. Inflation's been the elephant in the room for well over a year now. We've done episodes on it in the past, but there's been a lot of recent developments, like Thomas mentioned. So want to talk about, what's happened, why we got here, and what's going to come down the pike, or what to
Yeah.
look out for coming down the pike, because no one has a crystal ball.
Yeah. And kind of the how we got here, I think is so interesting because it really just goes to show that no matter how high up you are, a lot of people they don't have the crystal ball, like you said, and they think they know what's going on. They think they can predict the future, but they often can't, and I love the I don't love it, but it's comical to look back in the fourth quarter of 2020 or of 2021 when we were starting to hear these little tidbits on inflation, and everybody and their brother was using the word transitory, meaning it's not going to last long. It's just, here, but it's going to fade away. It's not something that will have a lasting impact. And then you see last year, right? Everybody in the fourth quarter of 21's like, this is transitory. It's a short-term thing. We're not going to have to worry about it too much. And then the Fed comes in, and it was either March or April. And that's when the hikes really started to happen. And, one of the things that I found so surprising is the steepness of the interest rate hikes, because last year we hiked rates faster than we ever have in the history of the United States, which is definitely, something to be noted in the fact that there's an irony to it, in my opinion, because of how the Fed interacted with the 08-09 housing crash, right? And I think what they were trying to do was protect us from getting there by causing more hurt from a stock market perspective up front. Would you kind of agree with that?
Yeah. They caught between a rock and a hard place is what I say they were. I don't envy Jerome Powell or any of the Fed members' positions.
Yeah.
They had a tough nut to crack, and inflation's a serious issue, and if it runs away on you, it could be a decade or generational long problem. I mean, we saw it in the 80s. Paul Volcker had to come down and absolutely crack down on inflation, and he had to raise interest rates at an unprecedented pace until last year. They did 4 interest rate hikes in a row of 75 basis points, and then proceeded with a couple 50s and a couple 25s, and they just finally paused for the first time since last year, this most recent month in June. But backing up a little bit, what is inflation, right? What causes inflation? Inflation is just simply the increase in goods to the consumer or corporations, the increase in goods. What causes it? Too much money chasing too few goods. So backing up, how did we get here? Well, we all know we went through the COVID pandemic. We get out of the pandemic, a lot, there's a lot of government stimulus, a lot of money flying around in people's hands. People wanted to spend it and they couldn't. So when we had the ability to do it, a lot of money was chasing too few goods. So we had a demand-driven inflation. That was really what was stemming at the end of 2021. We all heard about the supply chain issues. Then demand starts to, peter off, and the issue becomes the supply again, right? So demand was really high, and now we're at a point where demand's actually dropping. But inflation at one point, the second wave of inflation, was that there was not enough supply going around still. So it's a supply side issue. Now it's kind of changed again. The supply chain is relatively healthy, especially compared to where we were looking at pre-pandemic. But inflation's persistent. You look back a year ago and you could look at the headlines, and it was in June of 2022, inflation was at 9.1%. Now we're at 4, very low 4 handle, like, whoa, inflation's gone. Like, no, not the case. We're still dealing very much with it. And the cause for inflation right now, I mean, there's a lot of different causes, but in our opinion, in the research we've done, we find it to be wage growth. People keep making more. And if you make more, tend to spend it. What is the greatest killer of inflation? Inflation. Why? Because if the price of goods goes up too high and I don't want to pay for it, and no one wants to pay for it, it's going to come back down, right? So inflation kills itself, but with people continuing to make more money, it's going to fuel itself. And that's the issue the Fed is running into right now. Fed has two mandates, Federal Reserve. They want to keep unemployment low, not at zero. They want it at a healthy level, and they want to keep inflation low. Well, in order to get inflation lower, they got to drive unemployment higher. They don't want to come out and say this because that's not a great thing to say. Hey, we need to cause people to lose their jobs. But that's the issue we're facing. And companies aren't laying people off because they saw how hard it was to hire them a year ago. So they're not letting people off as easily. They may not be hiring as easily, but wage growth is still climbing. Inflation's still sticky. So they're in a pretty tough spot.
Yeah, and I think kind of, quiet quitting had a bit of an impact. Probably not as big as most people think, at least in my opinion. There were just a lot of people that were close to retirement age. They're like, you know what, we're just going to cash out of this thing.
Stock market was on fire.
Yeah, and that definitely changed from a labor perspective. And I think you kind of transition into the next segment of this, which is how inflation actually affects the economy, investors, individual people. And one of the most common questions I've gotten over the last 12 months was, why interest rates, right? Why are we using interest rates to tackle this? And really the essential factor of it all is when you have inflation, you have too much money supply imbalance in today's day and age. And so what the Fed does is they raise interest rates to decrease the money supply, but also to make it harder to attain and loan more money. And so they're kind of starting to cut off the supply of money. And that's going to affect two different categories of people. That's going to affect everyday people like you and me, and it's going to affect companies, right? And I think that's a lot of what we saw here in the early part of this year with the bank situation. Is there were certain banks that weren't utilizing their cash and investing in incorrect things to the point where their loans were overtaking them. And so I think that played definitely a role, especially last year, is rates increased so much that companies and people couldn't necessarily deal with it. I think that's also contributing to the housing situation that we're in right now, where if you speak to anybody that's trying to buy a home, they're like, I don't want to be paying 6-7% on a mortgage right now. So it essentially decreases the demand for those things, as you were talking about, and plays a role significantly in trying to bring inflation down. Is it the perfect measure? I wouldn't necessarily say so, but I don't also have the perfect answer. But it's kind of the bailiwick that the Fed tends to go towards when we're presented with a situation like this.
We're working with the information we have, and it's the best tool in their arsenal. Is it the perfect solution, like you mentioned? That's something that Fed has to figure out, right? But I love how you phrased it. I remember we talked about this the last time, right? I always use the example like the economy is a fire. You want it to grow. You really want the economy to grow, but in a healthy way. If the fire gets too big, that's an issue, right? So how do you turn the fire down? Think of a hose as interest rates. You increase the hose, you turn the fire down. But you don't want to turn that hose on a little too much and raise interest rates too high, because you're going to put that fire out and you're going to end up in a recession. And historically, the Fed has typically overshot their interest rates and kind of reacted quickly and swiftly. Overshoot it, we go into a recession, they quickly cut rates. So it's a quick teeter-totter. But as you mentioned, the impact of it is, if I want to go out and buy a house, I'd love to buy a house right now. Do I want to get stuck with a 6-7% mortgage? No. So it deters economic growth because people aren't going to spend as much. Well, car loans, right? Car loans.
Where I was going to go.
Financing on car loans. I don't want to have credit card debt right now. I don't want to have credit card debt ever, but it's going to cost me astronomically more than it would have just 2 years ago. So in all ways of loans and credit, like it's just much more expensive. When things are more expensive, we tend to grow less, which is a good thing because it cuts out inflation. But I wanted to hit on the housing thing because it's so interesting, because not only there's a lot of building going on. We don't really have the inventory of houses that we need as a growing economy. So you would think that home prices would start coming down as interest rates go up. They typically have that inverse relationship because you have to pay more for a home if interest rates are higher, so home values would come down. And they have marginally, but not as much as you'd expect. because inventory remains low. Because why would I sell my house with a 2 or 3% mortgage? That's what people have. It's a once in a lifetime opportunity, and people are holding on dear.
Yeah,
So
and this one of the most interesting things in my opinion, and I just saw this report came out 2 weeks ago, but the difference in inventory between new builds and currently built homes, right?
yeah,
It's insane the difference in inventory, especially now that we've kind of opened up the supply side of home building. It's and I'm very curious to see if that number continues to distance itself and how much more new home building inventory there is than current homes just because of where rates are. And one of the things that I did want to mention that I think we are teetering onto a much more positive long-term situation, in my personal opinion, is at least what the Fed is saying is we are going to stay much closer to a 3 to 3.5% nominal rate on rates once we get inflation under control. When that will actually happen is yet to be seen. But I think that the mid to late 2010s and even the early 2020s, we were just way too low on rates. It was zero. And there's definitely pros and cons in that. There's pros because rates on mortgages are super low. But one of the cons is you're missing out on free interest. And what I mean by that is through savings accounts and through fixed income through your investments. It was basically a place just to park cash. And I think that if we can get inflation under control and find that happy medium at anywhere from 3 to 3.5%, it's going to make mortgage borrowing for homes and cars a lot easier, a lot more. It's going to be half the cost that it is right now, but it's also going to be a good perspective from CDs, treasury bills, bonds, whatever it may be. And I think it's just going to keep everybody a little bit more honest, right? Because we don't want to go back to the 90s when everything was 10%. But we also don't want to be in those late 2010s and 2020s when it's 0%, because A, we're not getting any sort of yield on our cash or our fixed income investments. But B, it starts to create a unnecessary deployment of greed, because that's what we see sometimes is when rates are so low, there's not necessarily a consequence at that point in time for over leveraging yourself. And I especially see that from a corporation's point of view. So having a little bit more of a nominal, like a 3 to 3.5% yield that we stick with for longer, I think is long-term a much better, much healthier approach to essentially the solution that we're trying to look for.
so glad you brought that up. Right before you started going into it, I said, I wrote down a little note, inflation works on both sides.
Yeah.
Because you do, like, think about it, right? For the last 10, 15 years, the bond market, it's done well, but there was the acronym TINA. There is no alternative to the stock market because it wasn't the risk return ratio of being in the stock market versus the yield you were getting on bonds. Just it didn't quite make sense.
Yeah.
But I love the new acronym, FIFA, fixed income finally attractive.
Yeah.
So, but yeah, things have changed, right? Inflation works on both sides. Like how you mentioned, like back in the day in the 80s, right? Mortgage rates were 15%. Oh my gosh. Well, guess what? CDs were paying you 15% too, right?
Yeah.
Of course, somewhere in that range, but yeah, it works on both sides. And that's what we've seen a lot. People are taking the risk away from the stock market because they can get a decent risk adjusted return from the bond markets or CDs or money market with no risk. So it's definitely been a changing environment. And again, inflation works on both sides. Yes, it costs more to finance things, but you can get more out of your money and your wages are going up finally.
Yeah. So kind of on the last segment, things to pay attention to or look forward on going forward. I'd like to kind of present two different fronts. The first is, kind of the overall thought process, which you and I have kind of already explained here is that the goal for the Fed is we're just trying to get back to that 3% inflation rate, but also, well, actually 2%, sorry, 2% inflation rate, but also trying to stick at more of a 3 to 3.5% rate on interest rates. The other thing I was going to talk about is recognizing what happened back in 2022 and utilizing that as experience going forward. And what I mean by that is as you're approaching retirement or even just in general, there's a lot of benefit to having cash on hand but there's also a lot of benefit in recognizing that fixed income is affected by interest rates. Your bond positions are affected by interest rates. And when we go through these cycles, it's important to recognize, because as you're approaching retirement, most people are going to take risk off the table by increasing their allocation to bonds. And last year that sucked, right? It was just an unfortunate situation to be a part of. And so just kind of recognizing that sometimes things like that happening and having a bit of a backup plan is really important.
Yeah. Yep. Don't, you hear the, bonds are safe, stocks are risky. It's not always the case, right? Every single fund, every single security you purchase is different. They're going to have different risk characteristics. And on a slightly separate note, going back to like not what to do with inflation, but inflation itself. Here, I've heard the narrative, like the most recent CPI report, the inflation report, was kind of a mixed bag, but it was met really positively at first. Like inflation, like I mentioned, came down from 9% last June to now we're sitting at 4%. Fantastic. We dropped 5%, but 9 to 4 is a lot easier than 4 to 2. Trimming off the top. 4 to 2 is going to cause, I caution using this word, but some pain to the economy. It goes back to increasing unemployment, getting that wage growth down. Sticky inflation, when you look at CPI, the number that's reported on the news, that includes housing and food. You strip that out, you get something called core inflation. Core inflation, according to, I've got a little chart here next to me on Y charts, but in December of 2021, core inflation was 5.45. Now we're talking all about how inflation's been going down. Core inflation is the sticky part, right? Now it went from 5.45 to last month, it's 5.33. Has it moved? No, we still have a lot of pain to get down, right? There's still a lot of room to the downside that we need to go. I don't know what the impetus will be for it. Fed keeps saying higher rates for longer. That will, again, deter economic activity and growth. So I just, my opinion, we're not out of the woods from this whole inflation thing. And I've seen a lot of narratives out there saying, oh yeah, inflation's in the past, we conquered it. It's still sticky and it's still out there.
Yeah. And just reminding that they're still planning on doing at least 2 more rate hikes this year, and they're thinking July is going to be the next one. So it looks like we're taking a month pause, which begs the question, why did we pause in the first place? That's not a question that I should pose because I'm not in those meetings, but I think you're totally right in the fact that this is the opposite of transitory, right? This is something that we're probably going to be seeing for a while. And it also kind of, from a real estate perspective, begs the question, hey, if you need to purchase a home, don't try and time the market here, right? This is probably not going to be going away. And if you find the right place and it fits your financial plan, it might be the right option for you instead of trying to stick it out and, try and time the real estate market.
Yeah. Don't hold your breath waiting for those 2 or 3% interest rates again.
Yeah, for sure.
I think that was all I had for today.
Perfect. Awesome. Well, thank you everybody for watching and listening. Really appreciate it. If you have any feedback or any discussion topics that you'd like us to bring up, feel free and reach out to us. We always love, getting any sort of feedback or thoughts on things that we should talk about. So thank you so much for your time, Kyle. Really appreciate it. And we'll see everybody next week. Perfect.
Voila.